I made a little over $27,000 day trading GameStop. In this video, I want to walk you through my whole game plan of why I got in, where I got in, and my trading plan before I entered this trade. Not only will I show you how much I made, but I'll show you a quick clip of me live trading this with my StockHours community. Here's the clip. Bro, there's nothing in its way to like 1670. Bro, IV. Bro, this is the most.
Did it just go up again?
Yeah. Oh my God. Here we go.
Oh, here we go.
I got 550 contracts that I need to fill on that high. Oh my God, bro.
God.
Look, they got me all times in sales.
Let's go.
Now, before we start, you see I was excited during this trade. And that's because I never trade this stock and it was extremely fun doing so. So my game plan started with the momentum running into the day I traded GameStop. So for one, GameStop's an extremely shorted stock. And we've learned that through the original time that whole GameStop squeeze happened 2 years ago. Now, I wasn't trading GameStop based on previous history of degeneracy. There was a whole plan behind it. For one, I understood GameStop was extremely shorted. So the 30% squeeze the previous day told me we would see another push on this stock. The options market was pricing in another 50% move for the rest of the week. Now, what does that exactly mean and how do we measure that? Every options chain has something called IV. IV stands for implied volatility. To briefly explain what IV means, think of implied volatility as expected move for the week. For the most part, IV is around the same number consistently every week, unless there's a catalyst expected. For example, just throwing numbers out. If IV for SPY's options chain is 60%, it's usually around that number every week, unless there's uncertainty in the air, like a FOMC meeting on Wednesday. The IV will be higher due to the fact that the Fed can announce anything we may not already know, like lowering or hiring interest rates. IV has a direct correlation to the price of contracts. For example, if SPY's contracts are usually $200 with a 60% IV on the options chain, on a week where the Fed might be having a meeting and IV is higher, the price of the contracts will be more expensive. So as far as GameStop, the stock was already squeezing that week, and IV kept increasing rapidly due to the fact of uncertainty of possibly squeezing again. As you can see right here, this was the week that it was happening, and this is the day I got in. Now, does that mean the stock has to squeeze? No. The stock can literally stay the same or even come down. IV doesn't literally tell you if the stock's going to go up or not. Now, this is where you check IV on the options chain on Thinkorswim right here, right? Currently, it's at 125%. When I was playing this that day, when this touched $17.56, this touched about 273% on the IV options chain. So you can see the big difference here between 125% and 273%. That's over 100% change. So IV can't be the only thing that I'm watching. What I was also watching was the order flow on GameStop. I was seeing big chunks of share orders coming in at important levels. Now, I was checking it on times and sales. And what that means is instead of the normal 100 shares coming in or 500 shares coming in, I was seeing thousands of shares coming in worth millions of dollars. What that was showing me was I was not the only person watching GameStop, and there were big sharks watching this with me as well. The orders were millions at a time. I also knew that the $15 level was a very key and psychological level, which held up nicely during the day. As you can see, this $15 level held up real nice, right? As you can see, every time it came back down to that $15 level, it was either bought right under or all the orders were placed at that 15. Now, it happened in the morning where it wicked pretty quickly. It hit a low of $14.75 and quickly bought up to about $15.17 and obviously tried that push. Now, where did I look to enter, right? It was around this area where I ended up taking that entry on GameStop. Now, what I waited for was the $15.50 level to be taken out because there was a big wall there. Now, what does a big wall mean? Well, on level 2, I could see there was millions of dollars trying to be sold at $15.50. And I knew GameStop couldn't get past it. Every time we got to $15.50, it would come back and try again, as you can see in this area where it consolidated for about 30 minutes to an hour. Every time it came back to the level, it would get rid of some orders because people were buying there. Now, how do I see those orders? On level 2, right? On level 2, you guys can see that you can see the ask and you can see the bid. And I can see how many orders are placed at the bid and how many orders are placed at the ask. Every time this came near the 1550 level, I can see there was millions of orders just sitting there on that 1550 flat. Every time we came back to that 1550 level, it would knock down chunks of orders because there would be orders getting executed there. And where can I see that? On times and sales. So every time it chipped orders away, it was less and less volume needed to break that barrier. When we finally broke that, that's when I took an entry, as you can see right here. The next level that had a wall was $16, but there was so much Momo and volume that I knew it was going to be an easy break. So I added to my position. So this is the $16 level where I added to my position. We ended up breaking on the 5-minute. This had 800K volume. As you can see, this is where the volume increased after that 1550 break, right? This is my entry, and this is where I started to add at that $16 level, where on the 5-minute, we had over 800,000 in volume. Now, when we broke $16, there was not much in its way until the high of day, where I used that as my exit. As you can see, the high of day was in the morning here at 1640. My original plan was to wait for the overall trend to exit, which was $17.30. As you guys can see, it was on a 3-year where I showed you this was a wedge that was formed a very long time ago. This wedge started November 1st of 2021. So this is years in the making here. Now, I obviously had that in the back of my mind, and my idea was to sell into that wedge. So my original plan was to sell at $17.30, which was the top of that trend. Now, with every trading plan, you have to adjust your trade while you're in. Obviously, you can always have a 3-to-1 risk to reward, but when things are starting to tell you, all right, this is when you should take risk off, you have to adjust your plan while you're in that trade. It can't continue to be the same because there's a lot of factors that come into play that we didn't see before we got into that trade in the first place. So for me, the reason I ended up exiting that trade was at 1650, which was previous high of the day at like 1643. We struggled a lot to push. As you can see, we consolidated right here. So in my eyes, I was like, all right, this is where I should start taking risk off the table. But what I made a mistake of was not selling half and leaving some runners on the table. And those runners could have paid me another $30,000 to $40,000. So as you can see, with even a green trade, I could have done so many things better, right? I could have even sold a quarter position above $16, another quarter at high of day, and then left half for runners above $17. Now, at the end of the day, did I trade this to the full extent I could have? Obviously not. I could have took risk off and allowed a lot of my runners to continue above $17. But that goes to show you how even on your green trades, you could have done so many things better. And that's why journaling is such a big part of trading. Now, will I trade GameStop at all for the rest of the year or even next year? Probably not. This is like a one-in-a-lifetime thing for me. But what I want to start doing is start breaking down trades for you so you guys can understand my thought process, what I planned, and how I executed. I hope you guys enjoyed this video. I'll see you guys on the next one.